forward to what you've got to share.
And thanks, Becky. I really appreciate it. It's my pleasure to be here. I'm very passionate about not-for-profits. I've always worked for not-for-profit after my first job or so, and I think it's because I come from, as I say, I come from a line of do-gooder genes. My great-grandparents were missionaries and nurses and teachers and doctors, so lots of commitment to not-for-profits in my background. Thank you all for your interest. I know we have a good attendance on this call. I know a few of you, and it's good to see your faces. I don't know very many of your backgrounds. This presentation is going to start out super basic, but it's going to progress pretty rapidly, and I hope by the end of the presentation, even those of you who are pretty familiar with financials in a public, a for-profit environment will get something out of understanding how not-for-profit financials work. So with that introduction, you want to go ahead and start us off? Becky's going to be my Vanna. So here we are, next slide. The major thing you have to keep in mind about not-for-profits is that unlike for-profit organization that's committed to having a positive bottom line so the business can grow and give back to their shareholders or owners, not-for-profits have two purposes. And the first one is really very important. That's furthering the mission of the organization. That's why that organization exists. However, you have to make money. My first not-for-profit job was in Houston working for the Sisters of Charity, and one of the sisters taught me the bottom line there, which is no margin, no mission. If you are not making money, you do not have the funds to carry out your mission. So financial viability is really important. Becky, thanks. Next slide. Okay, so to use a simple model to start out, I'm going to imagine that your not-for-profit is a small orchard. It's like a fruit tree. And the system there is that fruit trees operate on an annual cycle. They bloom, the fruit grows, which you go back, thank you. They bloom, they grow, the fruit's harvested, it's sold, they lose their leaves, and they start over. So the financial, particularly the statement of activities, is a one-year look at what happened in your business. And it shows the fruit that was produced, what it was you did that year, and it shows the revenue, the resources that it took to produce those results. The other key financial statement is a statement of financial position. That's what its current name is. It used to be called the balance sheet. And it shows the value of your business, what assets you own. It shows any debt that you have, and it shows the cumulative profits and loss for the organization over time. Next, please. So the things that you'll see on the statement of activities, first it's the revenue, and it's all the revenue. So in an orchard, you think, well, that's the fruit that you sell, but you may also have a business where you let people come in and hold picnics under the apple tree, and you charge them a fee to use your orchard. It can be a variety of different things, and your organization will probably have more than one source of revenue. It can be donations, but it can also be program income. Your expenses are all the monies that you spend during the year to achieve that mission, to generate that revenue. Your revenue minus your expenses is now called change in net assets. It's been called lots of things in the past, profit and loss, excess of revenue over expenses, but for today, your auditor will call it change in net assets. As I mentioned before, the statement of activity is a one-year look. It's important when you set up your non-for-profit to think about what you want your fiscal year to be. Many not-for-profits have fiscal year ends of June 30 or September 30. There are some that are on a calendar year, but what you'll find is that the auditors that you're going to have are really busy auditing for-profit businesses that all have fiscal year ends of December 31st, and if you can stay away from that date, you'll get a better price on your audit because you'll be in their off season. So consider a fiscal year that's different than a calendar year. And the main thing that you have to remember that accounting is trying to do is match the resources that you use in your business with what is produced. That's the main thing to remember, is you're matching revenue and the expenses it took to produce it. Next, Becky. There are a few sort of non-intuitive concepts in accounting. The first is depreciation. So you'll buy some things for your business that are going to last you more than a year. And because you are trying to match the expenses with what you produced, that means those things that last more than a year, you have to spread the cost of that out over all the years you think you're going to use it. So any item that has a life of greater than a year and a cost above a particular threshold, and you get to set the threshold in your business. Some smaller companies choose $500. The federal government lets you go $5,000 if you do a lot of federal grants. The pros and cons of choosing 500 versus 5,000 is it's a lot easier to account for something if you just expense it and you don't depreciate it. If you depreciate it, you have to track the value of that depreciated asset for its life. So, so be judicious in what you set your threshold at. And the way you compute what you're depreciating every year is you take the expense of the item and you divide it by its useful life and come up with an average allocation for the year. View it sort of like your mortgage payments. You know, you've taken your house and you divided those costs up and you pay a mortgage payment over 30 years. So it's kind of like that. So there's another concept, cash accounting versus accrual accounting. For you, in your checkbooks, you use cash accounting. You write down when money comes in and you write down when money goes out, and that's the way you do your personal books probably, but most businesses do what's called accrual accounting. And that means that you are looking at what you actually used during that year. So on the revenue side, if you sold some apples to HEB, you had a fiscal year end of September 30th and you sold HEB some apples in September, but they didn't pay you until October, you sold those apples in September and they were delivered to the client then. So you record that revenue in September, even though the cash didn't come in until October. By the same token, you do that with your expenses. If you take delivery of an item and begin using it, that's the year that that item gets expensed, even if you don't pay for it until the next fiscal year. So it's accrual accounting is a little different. So the net result of both depreciation and accrual accounting is that when you look at your cash in the bank, it's not going to match what your net assets, what your bottom line is. So it's possible for you to show a positive bottom line, but because you depreciated a bunch of stuff and bought all that stuff, you might not have any cash left. So that's a tricky one. Next, Becky. So the second financial statement that you'll look at is the statement of financial position. You probably know it by the name of the balance sheet. It shows really the value of the business. It starts out with the assets, all the things that you own. Then it shows all your liabilities, your debts, your accounts payable, everything you owe. And your assets minus your liabilities equals your net assets. That's what's left over. Now, your net assets is equal to the sum of the profit and loss from all your previous years. And so I like the analogy there of a slice of wood, because your net asset is kind of like the rings in a piece of wood, that the diameter of that piece of wood reflects all the things that happened in all the years of that tree's life. Okay, Becky, next. The things that are on the the statement of financial position start out with assets. And the things on the financial position statement are listed in the order that they are easy to use and access. So with assets, it starts out with your cash and your investments, because those are the easiest things for you to use if you have to. The next is your accounts receivable, what your clients owe you. And even if you don't think your client's going to pay you for a while, there are companies that will buy your accounts receivable, so you can monetize your accounts receivable if you need to. The next is pledges receivable. If you've got a donor who says, I'm going to pay you give you $50,000, but I'm going to give you $10,000 a year, for the next 5 years, you record the whole $50,000 as a pledge receivable. That's an asset to you. You may, in your business, have inventory. You would include that. And then the last thing that you would list under your assets are your property and your equipment, and you record those at the price that you paid to acquire them, less whatever depreciation you've already booked on your statement of activities to date. Your liabilities, your short-term liabilities are going to be your accounts payable. It's going to be interest on any debt that you owe. And then your long-term liabilities are going to be the debt itself. So those are the things that are going to be on your financial statements. Next. So I just want to do a little simple example of the orchard, and then we'll move into some more complicated things. So you're going to start an orchard, and you borrow $5,000 to do that. You spend $3,000 of that buying trees. We're going to say the tree has a useful life of 15 years. So you divide the 3,000 by the 15, and you say, I'm going to expense $200 this year because that's my depreciated amount of my trees. You have some expenses in growing the trees. You do water, fertilizer, maybe you bought some boxes to batch up your fruit in when you pick it. So when the harvest comes and you sell your fruit, you're going to net $4,000. And since you've got some money, you decide you're going to pay back $2,000 of that $5,000 that you borrowed to get started. So let's see what our financial statements would look like with that as the brief data. So next. So our statement of activities, you're going to show $4,000 worth of revenue. Your expenses would be the $1,500 and then the $200 that you depreciated for your trees. And so your change in net assets is going to be the difference between your revenue and expense, which would be the $2,300. Your statement of financial position, you're going to have your cash in your bank, and you can sort of walk through how you get to the $2,500 worth of cash. It's your $5,000 loan plus your revenue of $4,000 is $9,000, and then your expenses, and then paying back the $2,000. So you can get to your cash there. Your trees on your financial statement are going to be the $3,000 that you bought them for, minus your $200 that you booked as depreciation for this year. So your total assets are the $5,300. You still owe $3,000 on your loan. And so your net assets are the $5,300 minus the $3,000. And you note that that also ties over to what your change in net assets was on your statement of activities. So, and it is called the balance sheet because your assets should always be equal to liabilities and net assets. And, you know, I'm sure most of you who've looked at a lot of not-for-profit financial statements have seen sometimes where people give you a balance sheet that doesn't balance. So, so those people need a little help. Let's move to the next slide. So some concepts that are really different in not-for-profit accounting than in for-profit accounting is donations. Most for-profit businesses don't get donations. And so, but not-for-profits do. That's primarily what they rely on. When a donor gives you money, they can give you money one of three ways. They can give you permanently restricted money, temporarily restricted money, or unrestricted money. And as a chief financial officer, you always hope for unrestricted money because you can spend it on whatever you need to. But that's not often what donors want to do. Permanently restricted money is, in essence, money that it's not an accounting word, but it goes into an endowment. It's there, stays there for eternity. All you can spend are the earnings on that money. And often those earnings are for a specific purpose. So I work for San Antonio Museum of Art part-time, and we've been fortunate enough to have donors who would give us $1 million to endow a curator in Asian art or a curator in American history. So The board will set a policy on how much of the earnings you can spend every year. Most not-for-profits spend about 4 or 5% of their permanently restricted amount on whatever the restricted purpose is. So at the museum, we spend 4.5%. So if somebody gives us $1 million, that means we have $45,000 a year that we can use to support the curator. Temporarily restricted money is either given for a specific purpose or a specific time frame. So a lot of not-for-profits will ask for temporarily restricted donations to fund capital equipment or to fund the launch of a new program, the startup money. Sometimes a donor will say, I'm going to give you some money, but I'm going to give you $30,000, but I'm only going to give you $10,000 a year, and you can use it for operations, but you can only use a third of it each year. So sometimes it's a time frame. The main thing to remember here is only the donor can restrict the money, nobody else. And unless the donor sends you something in writing that says they changed the restriction on that money, you can't spend it any way other than what the donor says you can spend it. And there have been documented instances where not-for-profits had to return donation money because they did not spend it appropriately. So there is a category of money called board designated funds. So if you happen to have a particularly good year as a not-for-profit and you generate excess revenue, the board may say, well, we really don't want management to just spend that money. We want to board designate it and use it for a particular purpose. And so the board can set aside that money. However, the board can change their mind whenever they want. So that's why it's different, is the board can change their minds whenever they need to. So a lot of organizations say, well, what we'd really like is to have a rainy day fund. Well, you really can't have a rainy day fund for a couple of reasons. You could do it if you had a profit in a prior year and the board designated it for unusual adverse circumstances. But here's the deal. They think that when you have set aside the money and you want to use it, that will count as revenue when you use it, but you don't. It was already revenue in the year in which you got that money, so you don't get to count it as revenue again. So it can be a supplement to cash if you need it, but it doesn't get to count again as revenue so that you'll have a positive bottom line. So that's the challenge with rainy day funds. Accounting for pledges is a really challenging thing. The way it works is when the donor gives you a gift and it's going to pay out over multiple years, you record the entire pledge the year that it was received. And that, as we saw in the financial statements, there can be a line for pledges receivable, and it shows up as an asset on your balance sheet. When the pledge payments come in, what you record is an increase in cash and a decrease in pledges receivable. No revenue gets recognized. And I will tell you that what has happened in the past to organizations that I have been familiar with is that you have a lowly clerk in development who receives those checks, and she logs them into the accounting system and she records it as revenue again. And I've seen organizations, when it came to year end and they discovered that this had happened, to be off on their revenue by hundreds of thousands of dollars. So so if you're affiliated with an organization that does have pledges, make sure every month someone looks at all your donations received and make sure that they're not really pledge payments and that they didn't accidentally get charged as revenue, because that can be a real issue for organizations. Next. So the statement of activities can be in two formats. The first one that you'll see in most audits is what's called by functional activity. And it's going to say, this is how much money we spent on all of our programs. This is how much money we spent on management in general. And this is how much money we spent doing fundraising, either by having our own staff or contracting it out. There's a second way that we'll look at, that's by natural class, because people want to say, but I want to see how much you spent on salaries. I want to know how much your utilities were. So audits usually contain that as well. The other thing that you'll see on the statement of activities is where the money comes from, so that there will be separate columns for unrestricted money, temporarily restricted money, and permanently restricted money. So those are some things we'll look at here. Next, Becky. So then the last of the three statements in the audit's financials are a statement of cash flow. It starts with your change in net assets, your profit. It adds back depreciation because depreciation was not a cash item that year. Neither were gains on sales or changes in accounts payable and receivable. It takes off if you bought any equipment that you capitalized, if you prepaid for stuff, if you have debt. So it is a complicated statement, and mostly the people who rely on that are more sophisticated financial statement users. Next. So Becky emailed all of you an example. It's the Utah Habitat for Humanity audited financials. So I'm going to give everybody a minute to find those, because what we're going to do is we're going to walk through those financial statements, and I'm going to show you all the things that we've just been talking about. So Becky, if you want to switch over and open that document. Okay, so you keep scrolling down, please. We'll stop on this page, but just go slowly and stop when you get to the bottom of this page. So yeah, so there you are. You might want to scroll up just a little bit so people can see that paragraph that's at the top. Okay, so the audit opinion, and this is really what you're paying for, is what the auditors give you after they do your audit. And it tells what they, what was your responsibility, what was their responsibility. The important thing to realize is that the financial statements belong to management, and they're not the auditor's financial statements, they're the management's. No, they're not the auditor's financial statements, the management's financial statements. So you need to make sure that your management team truly owns those and understands them. The auditors look at everything, and then so long as they can appropriately review all the financial entries that they look at, they give you that bottom paragraph which says, in our opinion, the financial statements present fairly in all material respects the financial position of Habitat for Humanity. This is what you want. It's called an unqualified opinion, a clean opinion, and that's the goal of every company. You don't want to get one that has any qualifications in it or it notes any material weaknesses. So that's the main thing here. So go on to the next page, please, Becky. So let's stop here and look at the assets of the Habitat for Humanity. Keep in mind that Habitat for Humanity generally has two lines of business. They build houses for people, for low-income people, and then they usually run stores where they sell their excess construction supplies. So they call their store here Restore. You'll see that down on here. So you look at their assets, and just as we talked about, the short-term stuff is first. So it's cash and cash equivalents in your short-term investments, accounts receivable, prepaid expenses. If you pay for a service all up front and it lasts for a year, that gets allocated out across the year. So you can see moving down, they've got their homes that are under construction, their inventory and their stores, and then some mortgages that they hold. So those are their current assets. And then down below that, you'll see property and equipment net. And that includes things that Habitat for Humanity actually owns, their own buildings, furniture, fixtures, all those kinds of things. it also reflects the mortgages that they hold. Those are assets because they issue mortgages to the people who they built the homes for. So you can see that there, if you scroll down just a tad more, you can see that their assets are $4.8 million. Their liabilities, their current accounts payable, the vendors that they owe, $76,000. And then they have some mortgage interest due themselves, that $57,000. So that's their current liabilities. And then when you scroll down, you see their long-term liabilities of $1.2 million, so that their total liabilities are $1.4 million. When you scroll all the way to the bottom, what you see is that their cumulative gains and losses since they started, their unrestricted gains and losses cumulative are the 3.3 million. They've got a little bit of temporarily restricted net assets, and they have their total net assets. So their total liabilities and net assets are 4.8 million, just the same as their net asset, their assets. So theirs is in balance. So let's move to the next one, please. This is the statement of activities. And what you'll notice here is that there is more than one column. On the income statement, you'll have your unrestricted column, which is the thing you're probably most familiar with, but then you'll also have your temporarily restricted. So let's focus on that one first. So when donors give them things that have some kind of restriction on, it shows up as revenue in that column. So you can see they got $157,000 worth of contributions and $207,000 worth of grants, and some money from a special event. You'll see a total there, but right above the total, there's a line that says net assets released from restriction, where it shows 313,000 in the unrestricted and a negative 313,000 in the temporarily restricted. What's going on there is that the Habitat used some of the money that donors had given as temporarily restricted. And when it's used, it moves out of the temporarily restricted column over into the unrestricted column. And so you'll always see those two numbers being the sign opposites of each other. So that's how money gets moved from your temporarily restricted over to your unrestricted. So the first section of here of the revenue, I just want to comment on that. There's two sections usually of the revenue. One is support. That's where you get your donations and external support. But then if you scroll down a little bit, you'll see the revenues, and these are the revenues that they earned doing their programmatic business. So Becky, you want to scroll down a little bit further, and you'll see the revenues there, their retail sales from their store, the mortgage discounts from the houses that they built and mortgaged out to the recipients. The transfer of the homes includes the mortgages that they put in place, and then some interest income, and then they also had $2,500 worth of gain on sale. So their total revenue that they earned was the 1.6 million, bringing their total support and revenue to the 2.4 million. Then on the expenses, this is the primary page of the audit. Shows the statement of activities, and so it is shown in the functional categorization. So you'll see that the categories are the program service expense. As I mentioned, they do have the two different programs, so the expenses associated with each of those two programs are shown there. And then under your supporting services expenses, you'll see the management in general and the fundraising. So the expenses in total are $2.2 million, and your change in net assets are the difference between that revenue and that expense. Because this organization has been around for a while, they did have considerable net assets from prior years. So the new net assets is computed by taking the net assets at the beginning of the year, adding that change in net assets to it, and coming up with the total net assets at the end of the year. So, so that is the statement of activities. If you, in programmatic form, if we go to the next page, you'll see the same information in a different format. The columns here represent, oh, I should say that once you spend the temporarily restricted money, those expenses all show up as unrestricted. So there are not any unrestricted, excuse me, there are not any temporarily restricted expenses. Becky, if you want to just go back up to the previous page for a second, you'll see here that there are support revenues, but other than the support revenues, there are no other revenues or expenses in the temporarily restricted column. Everything gets moved over. Everything is actually recorded as unrestricted. Okay, we can go down now to the next page. So, so here you see all the ways they spent the money in the categories that you're probably familiar with. And you know that these people use QuickBooks because QuickBooks has no way to order the lines except in alphabetical order. So, so usually if you don't use QuickBooks, you're going to list your expenses that have the highest volumes in them at the top of that list and then decrease as the value goes down. So salaries are a big expense for them, but they're not the biggest expense. It's the mortgage discount and the cost of the homes transferred are the largest expense categories here. So you can see the detail on how they spent their money for volunteer and family programs, how they spent it on the home improvement outlet, and there you see, no surprise, that the salary and benefits are the largest number. And then under your supporting services columns, you see the detail on your management in general and your fundraising. So one thing I'd like to point out, sort of as a commercial for the next class in 2 weeks, which is about the Form 990, is this is the level of detail, this is exact detail that is in the Form 990. The Form 990 contains all your expenses by natural class, and it's summarized by your program services, your management in general, and your fundraising. And when you go to sites geared for donors like GuideStar or Charity Navigator, they look down at the bottom line here and they compute a percentage for you. So what they'll do is they'll say, okay, we think efficient organizations are ones that spend most of their money on their program, not organizations that spend their money on management in general and fundraising. So they will compute the percentage of management in general as a percentage of that total expense. So the $90,000 as a percentage of that 2.2 million. And in this case, it's 4%. And the fundraising, the $80,000 is 3.6% of that 2.2 million. And those are very good figures. In general, if the sum of your management in general and your fundraising is less than 20%, that's considered an organization that operates well. Some donors will even consider it's okay to have 30% of your expenses on management in general and fundraising, but you're really hitting the ball out of the park if you're able to have those two expense categories be less than 10% like they are here. So they're doing a very good job managing this organization. So we covered these financial statements pretty quickly. I want to just take a breather here and ask if there are any questions on these financial statements or any of the things that we've covered so far before we finish up.
Question about insurance.
Yeah.
If you pay your insurance premium at the beginning of the year for the entire year, is that a prepaid expense?
Yes, it is.
Okay. And
the way it will work is it's probably going to be for a year, so they'll take that total premium, divide it by 12, and record 1/12 of that each month and show that as an expense. And that's especially important if your insurance year does not line up with your fiscal year, so that you make sure you're getting the right dollars in the right year. Yeah. Any other questions? That's a good question. So the question about when you're tracking the salary of the executive director, does it all have to be in management in general? Can it be allocated to a program? Absolutely it can. For example, at the San Antonio Museum of Art, the executive director was also a curator. So she was very knowledgeable about that particular gallery and was a great resource to the organization in terms of managing that collection. So the other area that you need to consider allocating that time to is fundraising, however, because most executive directors are also very good fundraisers. And although donors do care how much money you're spending on fundraising, and if you do have any federal grants and you ever want to compute an indirect cost rate, fundraising costs are not allowable expenses. So what I would recommend is that you take a sample, maybe a 3-month sample of your executive director's calendar, and go through and categorize everything that they do and come up with a percentage allocation of their time, so that you can say 30% of their time goes to program, 60% of their time goes to management in general, and 10% goes to fundraising. And then just use those percentages to allocate their salary for the next year or so till you're ready to do another computation on what their percentages should be. So is there a target threshold for overall salaries? No, because it's going to be so different depending on what your business is. This business, as you saw, has, although salaries is their biggest category, there are some other really big categories. So I've never seen that there was a target for overall salaries. I think people are going to look at what business you're in and seeing if that makes sense. And if you're an organization that uses mostly volunteer labor, that's going to be really hard for you, because it may make your program expense look low relative to your management in general and fundraising. So unfortunately, you cannot book as an expense volunteer time. You can, if people give you supplies, you can have that recognized as a gift in kind, but not time. Good questions, everybody, really good questions. Any other questions? Okay, well, let's flip back to the regular presentation. There's just a couple more things to finish up there. Next slide. Yeah, there we go. So whether you're someone who's in management for a not-for-profit or whether you're on the board, I would strongly encourage you to come up with a dashboard of key performance indicators. And these should be whatever is important to your organization. There aren't necessarily things that you have to have. Whatever you choose, it should be pretty straightforward. You shouldn't have to explain it to everybody every time they see it. You may have to explain the calculation the first time, or just tell them what they're supposed to be looking for, but it should be pretty straightforward. You probably need to have some financial ones. I would recommend that you have profitability, and then because donors are focused on what your spending is on your mission, I think that the percentages that we just talked about, what percentage of your total expenses is being spent on program, that's probably an appropriate one. And then in terms of operations, whatever your operation statistics are, if you're in Girl Scouts and you want to know how many girls went to camp, or you want to know how many girls earned badges, or if you are a museum and you want to know how many visitors you had, every organization is going to have their own measure of program activity. And I would encourage you to track that. And then another important one that I would recommend for operations is employee turnover. If you're employed, and you can probably find for your particular industry what the average employee turnover rate is. I worked in healthcare for a long time, and we had about a 33% employee turnover rate, which sounds terrible. It means everybody leaves after 3 years, but quite honestly, nurses get burned out. And so that was just a generally acceptable rate of employee turnover. So here's just a little example of a dashboard on the next slide. So what kills more businesses than anything else is running out of cash. And as I mentioned before, you can be profitable but not have any cash. So it's important to track both cash and profit. A common measure of cash is days cash on hand. You take your total expenses for a year and divide by 365 and figure out how much money you spend on average every single day. And then you divide that number into how much cash you have, and that tells you, if you stop bringing in any more cash, how many days you could live at your current spend rate on the cash you have. So a lot of businesses shoot to have 3 months or 6 months days cash on hand. You can see here they were targeting 4 months days cash on hand, and they're still working to get there. I would encourage you, as part of your budget process, to set these targets for your dashboard for the coming year. Then, whatever your excess of revenue over expense, I hope as not-for-profits, you're budgeting at least a break even and tracking it over time. Here's your turnover rate. It's important to track turnover rate in the context of what's appropriate for your industry, because if your turnover rate goes up, it may mean you need new training. It may mean you're not hiring the right people. It may mean you've got some problems in management that are causing people to leave. So lots of good information can come out if you track that. And then, as we mentioned before, the program expense as a percentage of total expense. So that's just some examples you might put on a dashboard. Let's see, we have another question. What's my position on in-kind? Should it be recorded? Yes, I think you absolutely should, because I think it's a donation, and donors like to see that other donors are giving to the organization. When you book the in-kind revenue, though, you book the in-kind expense, so that has no effect on the bottom line. But I think it is a good measure of your attractiveness to other donors. Any other questions on anything talked about?
Hi, Jeannie, it's Arlene. What about contractors versus salaried employees?
I think depending on what kind of business you are, there's a time and a place for both. If your business is really seasonal and it makes sense to have contractors rather than real employees, then that's appropriate. I think in the end that you probably build better continuity and retain knowledge about your operations if you have real employees, but that's just my opinion. What do you guys think? What do you guys, when would you think it would be appropriate to have a contractor versus a salaried employee? You got lots of good knowledge here in this group.
Well, for one, I think that contractors are more cost effective in certain positions within the organization. I think you also get some fresh ideas and perspective by having some new people in versus it staying stagnant.
Right.
So those are some of the reasons that I can think about having a contractor.
Absolutely. You know, having been a real employee for most of my career and then done consulting the last few years, I think you're exactly right that having a consultant or a contractor come in and review your financial processes, review your financial statements, just review whatever you have, you can absolutely get some good perspective on that. Yeah.
I think Bill put this in his notes, but Social Venture Partners, of course, is I'm a contracted employee, and a lot of that has to do too with what he was saying was we want to be able to be sure that we start the organization with healthy cash flow, and because I don't need healthcare and those types of things, it was much more cost effective for us, for the organization, to be able to have a contract employee rather than the employee costs that come with when you begin to, start payroll and payroll taxes and all those types of things. So yeah, I think you're right. It really depends on where you are in the life cycle of the business, as well as what your overall goals are for your year and what your revenue streams really look like.
And I agree with Nisi's comment about if you're a temporary project, you're launching something new, that's a great time for a contractor.
Mm-hmm. Let's start at 5:30. Oh, am I still on here?
Do they have different time zones?
I don't think so.
I think we have somebody that's talking. I'm trying to mute her.
Maybe I just lost connection.
Are there other questions?
Have any ideas they want to share? Questions? Well, Becky, do you have other guidance for us or things you want to talk to us about?
Well, just thank you, Jeannie. I mean, it's a lot, and it's a weighty content, which I think is wonderful, which is, you're so good at this, and thank you so much for all your time. We do have a few more questions. Could you go into more detail about how to split up the executive director's salary? Let's say we do this, if you've got somebody spending a lot of time on programs and management, how does that look, and how would you put that in the expense categories?
So
She froze up. You'll hang on just a second, folks. We'll see if we can get her back in. Sorry about that. Let me see if we can get Jeannie back in. She may have dropped out.
if you have a grant that spans fiscal years, would you classify revenue to be expended? Grants are a little bit different, and I've seen grant revenue classified different ways by auditors. I personally, it depends on whether the grant gives you the money up front or whether it's just released as you spend it. If it's released as you spend it, I would not classify that as temporary. Actually, I would never classify a grant as temporarily restricted. You will see on organizations that have a lot of grant revenue, they'll have another category of funds on their balance sheet that just recognizes the fact that a grant's been made, but it's not considered temporarily restricted. If you want to get more detail about that, I'm happy to follow up with you offline. And let's see. Short mentor programs, is it a fair time to seek contractors? Could you elaborate a little bit more about the mentorship programs? Because I guess I'm not 100% sure. If you're paying your mentors, then I think contractors are fine. But I'd like to hear a little more.
Yes, ma'am. This is Anthony Johnson. You're exactly right. If we're paying our mentors, but only for a short period of time, seasonally, I guess, would that constitute a good time to utilize contractors as opposed to part-time or even full-time staff members?
Well, I guess it's in the context. If you are running 12-week programs, but every 12 weeks you're offering the same kinds of mentors so that mentor can stay in place and just mentor different people over the course of the year, then maybe an employee. But if you're not running mentorship programs back to back, so you would have an employee fully engaged, then I definitely think a contractor would be the better way to go. And also, if you need different skill mix in your mentoring program, you for sure want to have contractors or volunteers. Yeah. So just like we all volunteer for social venture programs or partners. Yeah. Well, again, Becky's sharing my email, and I absolutely encourage you, if you think of a question later or say, you were going so fast, I'm clueless about what you were talking about there, just send me an email and I'm happy to answer questions or set up a phone call with you or a quickie Zoom or whatever we need to. I'm happy to help however I can.
I will also send out a link to everybody that registered and to our social venture partners to a video that we'll have of this, so you can go back and take a look at it again or scroll through this information again. So that will be another resource that is available to everybody.
I appreciate
I love
everyone.
seeing the, sorry, go ahead.
I appreciate everyone's thanks.
Yeah, I love seeing the faces of some of our partners, but also some of the nonprofits I know. Leah, thank you for being here, and Jasmine with dyslexia. And Angela White, she's my neighbor. I get to see her walking around the neighborhood too. But and Kimberly from Up Partnership, thank you guys for coming. And some of our other funders also. Anthony, it's wonderful to see you too. Melissa and Harvey, and then of course the people who make this possible for us are the social venture partners. As I said, I work for a wonderful group of people. We have 30 different partners that support me and help me make these things happen, and they have networks that they share it with. Our chairman is Billy Cox. Thank you, Billy, for doing so much. Others that have already left, that I would just want to say thank you guys all the time. Jeannie's one of our partners. Thank you for all the time that you spend to help me understand what in the world I'm doing on accounting. And I hope that when we all get back together again, when we can, that we have a chance to see each other and do this in person. There are people who are brand new partners that we have not been able to really be in the room with much. Alec, you're one of those that it'll be fun to be in the room with with you sometime soon. So we're right here at 6:30. Know that we will send the link out to everybody, and in 2 more weeks we have something that is also incredibly helpful, is understanding 990s. And again, thank you, Jeannie, for your help and for your partnership and friendship and all that you do for all of us. So I'll let you guys go. Have some supper. Taco Tuesday.
Yeah.